Welcome to TMS Insights. It's coming into the end of June, end of financial year. So just an update from us on what's been going on, what's coming up, and what to expect in the new financial year, Ben. This calendar year has been a pretty good one.
Yeah.
We're up about 4.5%, the ASX. June's actually been about 3.5% of that. So it's been a good start to June.
Yeah.
Things are bubbling on pretty well.
Yeah, well, certainly selling may go away. That hasn't played out again this year. I think, look, it's been quieter from a company announcement point of view recently, and that, we go into a period now where it is generally quite quiet.
Yeah.
But markets are doing what they do. They're sort of climbing the wall of worry. We've now got the S&P 500 and the NASDAQ are in bull market territory. They've both, it feels like a lot of that behaviour is around the start of a bull market where a lot of doubt and a lot of questions and those sort of things, but the markets are pushing higher. It's been a period, Jeremy, I think we're back to a bit more of that macro focus. I don't know whether that's because the news flow has been quieter or there is still, sort of feels like different areas are going forward or backwards or on hold. And maybe we can talk a bit
And on
about
that macro thing, last time we did an Insights, it was just before the RBA made their decision. Economists had a very low probability of a rate rise. We thought it would go up. It did. It's gone up. But the Fed paused last week, didn't they? So
yes.
In the US. So, and we had China cutting a couple of times in the last month.
Yeah.
So there's a shifting in that
completely
in the monetary environment.
And there's been a shifting in our market to reflect all of those things as well, I think, where you've got China is bizarre, I think. They're only 4.5 months out of lockdowns for 3 years.
Which
no inflation, no reopening.
Deflation, in fact. And so it's so different to what we're dealing with the West.
Everywhere else in the world.
Yeah. And remembering our quality of data from China sometimes harder to put a lot of reliance on, and we don't get much depth or explanation to why, but such a long and pronounced lockdown is going to have the same sorts of impacts overall that we had. So they're actually behind us in a way.
Yeah.
But they're trying to come out and stimulate and get busy.
It's the only country in the world that is in a rate cutting cycle and where the government is actually trying to drive demand.
Yeah.
Whereas everywhere else, we're trying to pull it back. And on the back of that, we've seen our resource stocks have had a leg up in the last few weeks. It's not so much what's happening right now, because at the moment the Chinese economy appears pretty sluggish, but it's more the message it sends that the government wants to get the economy moving again. And as we've seen in past cycles, the government, when it moves, can move very hard.
Yeah.
So it probably underpins resource prices for the moment. In America, they've now got an annualised inflation rate of 4%. That should drop under 3% next month. They're now on hold.
Because they're cycling really high numbers from a year ago, aren't they?
They had a month-on-month. The horror month was a 1.2 month-on-month.
In June last year.
And they'll get maybe a plus 0.1. So they could be at 2.9 next month.
We are talking about headline inflation as opposed to core, which will be what the central banks make decisions on. But it's nonetheless, it leads core down or up usually. So it's a good thing, no question. And that's what's really challenging policymakers now, is how much deceleration in prices is going on and when they might be the ones to stimulate, which is expected to be next year perhaps. So
it's also I think it's been quite miraculous that they've moved rates so hard so fast and the economy has held up so well there.
Yeah, it is.
And that's sort of, I think the fact that they're at the peak of their rate hiking cycle, hopefully, and the economy has actually been incredibly resilient is why you're seeing the US market push into bull market territory again. It's a different picture here, it feels like.
Yeah, and that's, I think, probably foreshadowing. Like you said, okay, what's coming up? We'll talk about tax loss selling in a moment. That's what's going on, perhaps. But we come to the end of financial year, reset, new mandates, new index weightings, all of this sort of stuff. But it's basically a bit quiet there in that early part of July. But then we'll start to hear, in advance of the August reporting season, a few confessions coming up or a few signals about results. And it's going to be an interesting one, Ben. I think looking at that August reporting season. So we'll bring an update at the end of July, and then obviously 2 in the reporting season. But there'll be a divergence in reporting, I think. What we were actually expecting in February will probably come in August.
Yeah, it feels that way. I think it's going to be one of the more interesting ones we've seen in some time, because I think, that clearly some companies are feeling some pain now from the rate hikes. Others are oblivious to it.
Others are benefiting from it. So
others are benefiting from it.
Yeah.
So CSL was an interesting one.
Well, I think that's one we want to talk about. Look, because when CSL, we came out of that February report, Paul Perot retiring, beating the table, saying things look great, and they still look great, but the profit warning really related to currency issues.
It did, but the guidance for this coming year was definitely weaker than the market expected. I felt it was a bit un-CSL, a new CEO coming in and having to downgrade guidance almost immediately.
That's the typical corporate playbook, isn't it? A new CEO.
Yeah.
But not CSL. Yeah.
You don't expect to see it from everyone.
Yeah.
But look, I guess when we listened to the earnings call there, what the CFO, who really spoke about it more, what she said was that these COVID impacts are lingering, and they're lingering longer than expected. And what she's mainly talking about is that the cost of running the 1,300 blood and plasma collection centres across America has been higher and more stubborn than expected. So it's things like energy prices, rent, staffing costs, PPE, etc. And then because the economy is held up a lot better than everyone expected, they're still paying higher than average prices to collect that blood from patients.
Yeah.
And so that's led to the margins still coming under pressure. And that was the main reason for the softer guidance for next year. Having said that, still guiding for 13 to 18% profit growth next year, which is still a pretty healthy number. Most companies would be thrilled for that, I suspect.
Absolutely.
Yeah.
And the component of it that is currency. I mean, currency is your tailwind today, your headwind next period. So it's sort of, as an investor, something you need to take certainly a longer term approach with. So CSL sold down $20-something, which sounds like a lot, but it's circa about 7% or something like that. So I mean, we're not really talking about a material change. The outlook remains good for one of Australia's leading companies.
Yeah, absolutely.
But let's talk tax loss selling. I mean, we know that in the driver of the NASDAQ, as you said, clearly in a bull market, is a concentrated number of stocks. Whether it be in the US or Australia, below the top stocks, there's not a lot that are actually moving. There's been a lot been selling down. Some of that's tax loss related.
I mean, I saw a good article from a really good small cap investor saying that the micro caps and small caps haven't been this unloved since the GFC.
Yeah.
And you wouldn't realise, but there's actually like a full-on bear market in that part of the Australian share market. And it tends to exacerbate into June 30. And it's for two reasons. The first is that fund managers who might be in stock A and it's had an awful year, as at June 30, they have to disclose to all of their investors what they owned. It's the only time of the year they have to do it. And the tip, 99% of the time, they'll look at it and say, just get rid of it. We don't want to talk about that for all of July and August. Yeah. And then you've got individual investors who can also sell to offset other gains that they've made. So what you tend to find is that those stocks that have had a really nasty 12 months, it spirals into June 30 and then it can sort of gap higher in July/August when all of that selling pressure is relieved. So I think it's definitely been a feature in the smalls this year because the smalls have had such a rough year.
Yeah, it's been accentuated this time as opposed to others. New mandates starting at the new financial year, investors looking for growth, stock specifics come into focus. Apart from watching out and making sure that you don't have the stock specific concerns leading into that August reporting season. And again, we'll talk more about that late July. I mean, where are the big parts? Commodities have sold down, tech's run well. A lot of consumer discretionary stocks, are generally struggling. Yeah. Is there a particular pocket of value?
For me, it's healthcare.
Yeah.
Because I just think you've got global, almost locked in growth. So it's the stocks like Fisher & Paykel Healthcare, CSL, although I think that's going to have a little bit of time in the sim bin. ResMed,
Ramsey,
et cetera, et cetera. I think they're areas in a growing, that we all know there's this great long-term thematic.
Yep.
But they haven't had a great year this year. They've been left behind.
Yeah.
The growth stocks it's been tech, which has really driven the growth stocks. And I think healthcare's it's a pretty good place to be at the moment.
Yeah. And lastly, it's been in commercial property probably where we've seen a lot of the pain, but property's another space in the market, the listed part, where you're seeing a lot of price action.
Yeah.
It's gone down.
Yep.
A lot of stuff trading well below asset backing. Concerns that might be well stated but overstated in prices.
Yeah.
How do you see that one?
Well, I like Dexus has just put out an announcement where they've had 100 and don't quote me on this, 170 of their 182 properties independently valued, and they've taken a 6% valuation drop against their December valuations. The market's pricing that at a 30 to 40% discount to December valuation. So it looks like a really compelling opportunity, but we know that there's probably more pain
probably
to
a bit
come.
more to come, there.
But the market's already there.
It's already there.
Same with the retailers.
And that's it. And that's the part from an investor's point of view, you've got to work out. The price gets there a lot faster than the valuation. So
these things could conceivably start running when maybe that last bit of news is at its worst.
Yeah.
And because you do often see that.
The share market's a forward indicator, isn't it? So, great. All right, Ben, thanks for that. Well, we're wrapping up the 23 financial year, a good year for a challenging year in other ways, but looking forward to bringing you another update in July.